a company to do your, like, should you keep an eye on something? Should you?
No, so the good thing about having a company to do it, especially if they're doing like the full payroll, which means they're filing all the tax forms, they're paying all the tax payments, is they're the one that's gonna have the liability. So if something's not filed or paid on time, that's on them. Okay, and I know if you set it up with QuickBooks, you'll have to sign a power of attorney so they can file all that for you on your behalf, because they're filing it for you, for your company. So there might be a power of attorney involved, but they're also taking the liability in that.
So it won't be like if you had a tax person do your taxes and they didn't do it correctly, the IRS comes back after you, not them.
Well, you might get the IRS letter, but then you would send it to your payroll people and be like, hey, why didn't you?
They're not gonna file your corporate tax returns.
I'm saying for example.
Yeah, like the 941.
Another friend, she had Aspen Meadows Pet Resort. And her tax lady that she was using did file her taxes either correctly, and the IRS came after Aspen Meadows, not after the lady who.
Well, yeah, they're gonna send the letter or whatever to the business address, but if you have someone doing it for you, like a payroll company, then you would send them that and say, hey, why did this get paid? Or why did this get filed on time? I should be getting these notices.
So then they pay any kind of fees or interest or penalties.
Yeah, as long as it's a reputable company.
Yeah, like Gusto and QuickBooks do that.
Okay.
But I've never seen them ever.
There's
Ever.
paychecks and ADP and.
Yeah, I've never seen them not do it, so.
Just make sure you have your record that you paid them to do it.
Yeah.
Yeah,
Don't throw that receipt away.
I mean, generally they will, like, if you have one of those companies, you have an account, right? So they're gonna put copies of everything on your account that you can access. So maybe like every quarter you just check that the forms are there. And obviously you can see in your bank account that the payments are coming out, right? So if you do have employees, like payroll taxes should be paid monthly, usually.
So then you go into your QuickBooks of what they, say for example, she's my employee, and a certain amount of money went to Social Security, Medicaid, state tax, whatever.
Right, then you're sending.
So then I'm taking what they basically paid her and putting it into my QuickBooks every pay. Well, am I doing that or no?
So if you're using an outside source like Gusto, those entries are not gonna be in your QuickBooks, right? So your accountant or bookkeeper would then have to make entries into your QuickBooks to show all that payroll stuff coming out. But if you have QuickBooks Payroll, because you're already using QuickBooks and everything, all the entries are gonna be recorded in your books. But if you use an outside source outside of QuickBooks, then you have to manually enter those. Cause so I have some clients that use QuickBooks, but they use Gusto for the payroll. So since I'm their bookkeeper, then I have to go in and put those payroll entries into their books so that is recorded if it's like a separate company like that. But if you do payroll within QuickBooks, then QuickBooks is gonna automatically put those entries in for you.
So is there a magic number, would you say, when you get independent contractors, when you should switch over to employees to protect us?
No, there's no number, no dollar figure really, it's just how they're working for you, right?
Okay.
Like.
Yeah, look at the Colorado law and make sure you understand.
Yeah, like I said, you're not telling them to be there Monday through Friday 8 to 5, or like they come in when they need to. Like I am a contractor for all my clients, like they don't tell me a set schedule, I have to work on their stuff between this and this. I use my own laptop, I don't, even when I go into their business, I use my own computer, I don't sit down with their computer, that kind of thing. That's all they're gonna look at, they're not gonna look at a dollar amount, they're gonna look at how that person works for you. Are you telling them what to do like an employee, or are they like seriously doing their own thing?
Okay. Well, like in our case, we have one college kid that helps on some bigger installs. So we do tell him like what time to come to help, and he does use our tools, but it's maybe, 10 hours a week.
Yeah.
I don't know if we should worry about that. I mean, he is an independent contractor now.
So it's something that you will have to think about. There's actually a class that you can take through the Small Business Development Center. It's $500 and it is well worth it. I would pay $15 grand for it.
Okay.
And it's a 10-week course, and you meet once a week, and it's for like 3 hours, and it's a lot of information, but they take you through everything that comes through legally, everything that comes through where you could get sued. Like, I didn't know, I do deliveries in my car. I load them in my car and I do deliveries. Well, even though I'm an LLC, right, you think your business is protected? Well, if I get into an accident, they're gonna come after not only my business, but me personally, because it was my personal car. It wasn't the business car. So there's like little things you don't even know about, and they talk specifically about this, being that you tell him when to go to work and he uses your tools.
That
He's
sounds like an employee, yeah.
He is
The
an
state's
employee.
gonna say.
So you could say he's not an employee, he's a 1099, but no, he's actually employed, and that's when they're gonna come after you.
For
But
payroll
I would
taxes.
highly recommend any of you guys, I'm actually gonna take the class again, because they help you with a whole business plan and everything. I mean, you're pretty much 99% guaranteed to get your business loan. It's a lot of information, but it will keep you from failing. I wish I would've taken it 24 years ago.
What was that class called?
It's called Leading Edge.
Yeah, and it's Mark who teaches it. By far, hands down, I praise this man. This man is amazing. He is amazing. Like I said, I'm ready to pay to take the class again, because if you're going into a business and you're still kind of like, feel like you're swarming around a little bit, you don't know exactly what's going on, you call him and he goes and meets you and he talks to you and he goes through all the numbers with you, and he helps broaden your horizon, and you can actually see, you're coming out of the trees and you can see above the trees. I highly recommend it. But especially when it comes to anything that's legal. I've been doing so many things that are legal I didn't even know, because I didn't know. I know they have attorneys that you can talk to, they've got tax people you can talk to, they've got, but for the basic, I wanna know the basic, I don't know the basic.
Right.
So,
Yeah, so by the state and IRS definition, that's probably an employee. If they were ever to come in and look at it, they would say,
Think of it this way with a contractor versus an employee. Contractor, you give them deadlines, employee have a schedule. Like, have this done by December 3rd.
and you work on it whenever.
Right, I don't care what you do, but it needs to be done by December 3rd. That's kind of a contractor state. Whereas
And then the
it's-
own tools is a big one.
tools is a big,
Yeah,
big
that's-
one.
If they
Okay.
use their own stuff to do the job.
Our hope is that he's gonna start doing some of the easier stuff on his own time, and then, we come in and finish out more like an independent contractor, have this and this done by Saturday, but it's still more of an employee, cause we're not gonna have to use his own tools.
Yeah, cause like if you came in and worked, if you ran my embroidery machine, you're using my equipment, so you
Right.
can't be 1099.
Okay, good to know.
Yeah,
I gotta break this news to my
so
husband.
you might have to get some payroll.
Well, and you can meet with Mark Biddle, we can chat afterward.
Yeah.
He's a generalist consultant as well, so you can have one-on-one consultation with him, just aside from the class. To
What is
kind
his
of
name?
Mark Biddle.
He's good, he's really, really good. See, and Mark.
Yeah, I know, like, you're like our greatest champion.
Yeah.
And I know Mark too, so. he's
Yeah,
been-
Mark is very, 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 very educated, very, very good. I mean, like I said, $500, take the class. Seriously, take the class. And you meet so many other professionals that do things that you need, and you have that connection, instead of like being alone. Like, I did everything alone for 24 years. Now I'm like, what the heck? But I was raising kids all that time, so it was a little harder. But anyway, sorry, go ahead.
Yeah, no worries, okay.
So Gusto.
Yeah, Gusto is a good one. They're very affordable, like way more than ADP and stuff, and
So like a roundabout figure, how much do they cost? Does it depend on your
Well,
employees?
yes.
It depends on the number of
Most-
employees you have, but generally it's like
And what service?
$20 to $30 a month a base, and then you might have to pay a little more if you have more
$20 to
employees.
$30 a month?
Yeah,
That's it?
That's what I'm saying.
Gusto
Oh
is
my
great,
gosh.
and it's really easy to set up, and they do everything for you, like you seriously don't have to.
And so that's what you use, so like you basically handle their bookkeeping for the company. And then you send it to Gusto and they actually like cut the checks and everything. And
Yeah,
that's what
you
takes
can
the
set up direct-
liability out of you.
Well, we set up direct deposit with Gusto, so if you're actually having to do checks, then your bookkeeper will have to actually write checks and send it out, but usually on my payroll people, we do direct deposit and everything's set up electronic. Even hourly employees, I'll just enter their hours in, salary, it's done.
So if it's like 5 to 10 employees, it's probably no more than $50 a month.
Right.
Wow.
Okay, recording
Yeah,
wrong
that-
dates on income or expenses, so again, if you're cash basis, just be sure you're recording, in your books, right, the date that actually money came in and the date that the money actually came out.
So you
neglecting,
can use your bank statement
yes,
if you're cash basis, you don't have to, like, if you buy it from Walmart, for what, if Walmart's computer
Exactly.
screws up and it doesn't come out of your bank account for another week, the date that QuickBooks pulls in, you can still use that. date.
yes,
Okay.
if you have the transactions downloaded in QuickBooks, just use that date that it
Okay.
comes in. Or whatever's on the bank statement or credit card statement, that's what I do, cause, you know, a lot of my clients, I'm doing this like after the fact, right? Like the month's already happened, I get their statement, and when I'm entering it, I just use the date on the statement. Neglecting sales tax, so if you are selling products, coffee, landscaping, I'm sorry to say you'll have to deal with sales tax in Colorado, which is very complicated. I have another slide over here about it, but
Just for the materials or, so I just do the design, so it's just services?
yeah, if you're just services, then you don't have to deal with sales tax. So sales tax is only on like tangible property, so if you're selling a physical item, right?
And actually, if you go to their website, they do classes too, that you
Yes.
can go to, so, you know, cause like with you doing the cold coffee thing, you'll be able to know, cause like. the
You'll
mistake
wanna take sales tax classes, yeah.
The mistake I made was I had the wrong percentage for sales tax in there by accidentally typo, and so you have to eat that.
Yeah. Sales tax is
Yeah, so I would.
just
look up
know
the sales
that
tax.
if you're selling a tangible thing, that you're gonna have to collect your sales tax, yes.
Wouldn't that be the difference between something you can move around in real property? For example, I do art, and so if I do a mural on a wall in a house or a building, that's real property as opposed to
Right,
what you're talking about.
Right.
I
Opposed to
don't, I
like a-
just do stuff that I don't have to do.
Yeah, you don't have to worry about it.
So I
Correct.
wanted to clarify that, so I'm like, I don't.
Yes,
charge
good
sales
question, yeah.
Yeah, no, see, if you came to me and I digitized your design for you, for embroidery, and you were gonna take it somewhere else, I don't charge you sales tax on that.
Yeah, just a service.
If you came to me and I digitized the design and then I did the embroidery for you, then I charge sales tax, because then I'm doing the embroidery for you on a garment.
But it's a product that's.
It's the
as
product.
opposed to
Yeah,
real
so if you're
property.
painting a
digitized is
mural,
not-
it's still like a service, cause
Yeah,
you're not selling them that wall, you know.
So it's a tangible versus real property?
Yeah, so for your stuff, if you're just painting on someone's wall, you're not selling them that wall, right? You're painting on the wall, which is a service still.
That's what I thought, is
Yeah, yeah.
Yeah, which is gonna be different for like the landscaper, because what they bring in, they're leaving their materials part of
Yeah,
that.
they're charging their, yeah. Alright, next one, not keeping records for 3+ years, so,
The ties, the,
well, cause I write paint, I don't, you know, it doesn't make
yeah,
sense.
that's,
yeah, just, you don't have to do sales.
you know,
So the state and IRS can audit you up to 3 years after you file your tax return. So just know you have to keep your records at least for 3 years. I know sometimes they say hold stuff for 7 years just in case because of like bankruptcy and stuff. So so you generally want to keep stuff for 7 years, but for like tax purposes, you only need it for 3 years. Okay. And then 11, trying to do it all yourself without help. So if you're struggling, you know, I know not all business owners are also going to be accountants and bookkeepers, right? So if you are struggling, definitely find a bookkeeper to help you. Okay, I'll quickly go over depreciation, but depreciation basically lets you deduct the cost of an asset for your business over that asset's life. So assets are, again, property, tangible or intangible. Tangible is something that can be touched, like an office building, vehicle, equipment, furniture, computer. A tangible asset can't be touched, such as intellectual property, a patent, copyright. Both tangible and intangible assets can be depreciated. For intangible assets, things you can touch, we call that depreciation. For the intangible assets, we call that amortization. So if you see that word, that's just what that means. What kind of assets can you depreciate? So the IRS has guidelines on what types of assets you can't depreciate. You must own the property. Even if you bought it on a loan, right? That still counts as you owning it. It just means you're not leasing something, right? So if you physically bought something, even with a loan, a piece of equipment, that's still something you own, okay? It must be used in your business or income producing activity, so you must use it in your actual business. It must have a determinable useful life, which we will go over, and it must be expected to last in more than 1 year. So that's the IRS guidelines for the assets you can depreciate. So useful life, the IRS also has guidelines on those. So generally 5-year property are things like vehicles, computers, office equipment. 7-year property generally offers furniture. And then residential rental property, so if you're renting out a residential property, that's always 27.5 years. And then office buildings or commercial property is 39 years. But generally in a business, everything falls in this 5 and 7-year category, unless you're doing like real estate, okay? And then we'll go next how to calculate depreciation. You basically will take the total price paid for your asset and then you divide it by the life. So there's different types of calculations for depreciation, but straight line just splits an asset value evenly over multiple years. So for example, if you have a $5,000 piece of equipment, that's a 5-year life, you divide that by 5 years, you would get $1,000 deduction every year, okay? And then there's also a double declining formula, so it lets you write off more of an asset's value up front after you buy it and less later on, which is a little more accurate because usually when you buy something, it's better when you first get it, right? And then it deteriorates as you use it. So the double declining is what a lot of tax preparers use. There's a whole bunch of formulas I'm not going to go over, but if you can't sleep one night, you can look at how to calculate that. Basically, I just want you to know that generally you guys don't keep track of depreciation in your books. Your tax preparer will do that. So, and they'll usually do an adjustment in your books to record that depreciation that they do on the tax return. But I just want you guys to know that there is a depreciation expense for your business, and just be sure to tell your tax preparer the assets that you purchased for that year so they know. And then depending on, like I said earlier, your net profit, your tax preparer may want to expense that asset fully in that year to get you more expense, to get your income down. Or if you already have a loss for that year, maybe your tax preparer will want to do the straight line depreciation cost, right? So you have a little bit of cost over 5 years. That way you can kind of keep some of that expense for the next years if you already have a loss in your first few years of business, which a lot of businesses do have a loss.
Is there a threshold dollar amount for not-for-profit that, like, we've had a lot of things donated to us, but we've bought 2 laptops for the kids to use. I think they were like $1,000 laptops. Can those just be expense? Like,
Yeah.
Like, is there? Do you know if there's a cap at the dollar threshold where we would have to depreciate?
Not really. So
Okay.
they don't really, like, there's no legal amount by the IRS or state.
Okay.
So it's generally up to you
Okay.
whether you want to just expense those or, like I said, in public accounting, we generally use $1,000 rule.
Okay.
If it was over $1,000, then we'd asset depreciate. If not, just expense. Business mileage is a good deduction if you're having to drive a lot for your business. So if you're ever audited, the IRS wants to make sure you have a log with the date, the destination, the distance, and the business purpose. So there's a lot of apps out there for you to use now. I know there's like Mile IQ, there's like a whole bunch of stuff you can use on your phone to track this. And even in QuickBooks, they have a business mileage thing in there now to help you track that. But I just use my Google Calendar for me because, you know, my Google Calendar is easy because I'm already logging the date, who I'm meeting with, right, and the address. So I just have to calculate the distance. So I use my Google Calendar as kind of my log because if I'm driving to meet a client, I already have half that information in there, right? So, and you definitely want to record as incurred because it's very hard to go back after the fact, right? Think about a year later, where did I drive? What was the distance?
What does that mean, report as incurred?
Huh?
What does that mean, report as
Like
incurred?
as it happens, right? So
Like
you
if
don't
you
want
drove
to,
50 miles today, write it down in your
Right.
calendar today.
for this, you don't want to wait like 3 months later, the whole year, and you're like trying to think about all that. everywhere you drove, right?
So is it true if you, like, let's say, for example, I was coming here and then back home, but I decided to stop by Walgreens to grab cold medicine, then I'm not supposed to be able to add those miles because I stopped for something personal?
Right, exactly, and then, yes,
So that's true.
yes.
How do they know you stopped at Walgreens?
Yeah, how would they know?
Well, they track you wherever you go right now.
Did you have a phone?
I mean, if she puts it in Google that she's coming here,
Yeah, I don't
Yeah.
put in Google that I stopped at Walgreens or Starbucks and got a coffee, so.
I mean, if you went by, if your odometer said you drove 20 miles, you could just say I went to a class and drove 20 miles.
Yeah, see, that's
If
the
you
thing,
said I drove
is the
from my
mileage.
house to Chamber of Commerce, and then they decided to get nitpicky, say, oh, you really only drove 17 miles, you didn't drive 20. But, you know, if you just said I went to a class,
Yeah,
and
so
I
do
drove
you
20
just say
miles.
class, or do you have to say the Small Business Development Center bookkeeping class?
well, I think the more specific, the
More
better,
detail is
if you have the info.
better. More detail is better.
Yeah, especially in an audit, right, you can be specific. I also have everyone record their mileage on January 1st and December 31st every year because, I also have to know as a tax preparer the total business mile driven for the year. Because on your taxes, it kinda takes a percentage, so it takes your business mileage over your total mileage for that year, okay? Because on the taxes, you can either deduct the auto expenses or the mileage, whichever is higher but not both. So sometimes you have to see kind of which one is higher. A lot of my clients, obviously mileage is usually the higher one. You know, unless you have a bunch of auto expenses, generally I see mileage is the highest one, so. The 2021 rate for mileage is 56 cents per mile, so that's the deduction you would get for mileage for 2021 is 56 cents per mile, business mile that you drove.
So if you did the mileage, like, for example, like I have some clients that have that unlimited car wash. And so they go through, so then they would be able to deduct the unlimited.
Car wash.
Car wash.
Right, it's either mileage or expenses, whichever is higher. Meals and entertainment, okay, for taxes, the deduction is limited to 50% for meals. Entertainment expenses are no longer deductible, the IRS got rid of that, okay? So you can no longer do your sports tickets, you know, your Broncos tickets, your show tickets, they got rid of entertainment, okay? So if you take clients out to a show, or say a baseball game or whatever, if you pay for their food, make sure it's a separate, like, expense, right? So your tickets are on one transaction and all the food is on another, because you can deduct the food, you cannot deduct the tickets, okay? Yeah, they must be separated, food and entertainment expenses must be separated, so you can just deduct the food portion. And then, if ever audited, the IRS wants to see who, when, and where in the business purpose. So generally I have my clients, if they go out, take their clients out to eat and they get the receipt from the restaurant, right? They already have the amount, they already have the restaurant, they already have the date, to just simply write a simple note who they met with and had business meeting or whatever, and then just scan that receipt and you're done, okay? So that's an easy one to do.
So for client appreciation type events, probably do more of a meal or something like that.
Yes, because the entertainment's not gonna be deducted anymore.
Okay.
Yes, if you feed them, yes.
So what do you, like, I mean, we're not for profit, so we may be different, and that's where my accounting degree
Oh, yeah.
gets fuzzy.
Nonprofit doesn't really matter, because
like-
you're not really paying taxes,
Well, like we do like group building, like when she has a group of interns, she might take the group of interns to do like a escape room. She's paying for that with the not-for-profit money. I mean, we have it I literally have a QuickBooks account called Meals and Entertainment.
right,
It's
yeah,
in
everyone
there
does.
Because
always meals and
it's,
entertainment.
because we kind of viewed it as entertainment. Should I change that to group building
Yes, for that
program
kind of stuff.
expenses and then just not really have an entertainment?
Yeah, I would separate that, yeah.
Okay.
Cause I know all the QuickBooks templates, so they all have meals and entertainment together, but yeah, you can no longer deduct entertainment with the IRS, so.
Yeah, cause she's not, I mean, she's still gonna wanna entertain the kids,
Right.
cause they're just a little.
And with the
interns that don't-
nonprofit, the
you know.
IRS isn't gonna really care,
Yeah,
cause it's
okay.
just more,
So no big
recording,
bookkeeping.
so, yeah, I would just call it something else and just make sure you have one just for meals, so you see all the meals are separated out from
Okay.
the other group activities.
There are conditions on the deal, like if I buy myself lunch today after the staff, am I writing that off too, or is it just like
Yeah, no.
taking out clients?
Yeah, generally it's just supposed to be like, you know, you're meeting someone for a business purpose. So if you're just stopping yourself, generally no.
But you can take me to lunch and write it down.
That's right. We can all go out to Starbucks afterwards or something, okay? Like I said, the IRS wants to see who, right, so.
Well, it's like 50%, so you're really only writing off what you paid for
Right,
that
it's
person.
only 50%, yeah.
Yeah, you're not writing off your personal fees.
But I don't think they're gonna buy, I met with myself and had a business meeting at
Yeah.
Starbucks, that's,
Gotcha.
okay.
So if you make a separate check, like your own food and then the group, the guests' food?
No, you.
Well, if you're meeting with the client, you can deduct your portion of it too. I'm just saying if like you're just by yourself and you're not meeting anyone, then that's not really a business purpose.
I'm back on entertainment and
Oh.
meals.
Yeah.
So no entertainment, you can't take them to the movies, but you can, buy a popcorn.
Yes.
So since we're not profit, we don't pay taxes anyways, can we take our total meal ticket and put it into meal expense? Or do I
Yes,
have to
you
go
don't
by
have
that?
to, yeah,
Okay.
you can just put,
You only-
record the total meal.
Cause it would just be for our books, like for trying to get grants and stuff would be all, so we can claim the whole thing
Yeah.
for like a
And
grant.
all my clients on their books, it's gonna have the 100%, just on their tax return, it's gonna be knocked in half, so. Yours
But yeah,
will,
I mean, all I really do is the postcard and then if
The
we have a
990?
the 990N, the
oh, yeah, the
postcard.
postcard, that's really easy, yeah.
But, yeah, it takes like 2 minutes, but I still do a P&L for like when we're applying for a
Oh, yeah,
grant.
totally.
That can say we spent $1,000
Yes,
on
that
something
can
and we
say
don't have.
100%,
Okay.
yep, totally. And again, record these as they happen, right, not after the fact, cause it's really hard to go back and try to remember who you met with, what you talked about, right? So,
So training is the next one?
yeah, get that receipt for the food and just write down who you're with, what you discussed, scan it, and then get rid of it. So there is a home office deduction too, so if you use a part of your home all the time for your business, you can have a home office deduction. So it's limited to your net income, so if your business is already reporting a loss, you can't add a home office deduction to get more of a loss. Basically, you have to have income to get this deduction, right? And so the simplified option is basically just you get a $5 per square foot up to a maximum of 300 square feet, so.
Only 300?
Yeah, that's the max on the simplified option, so you're gonna take, the square footage of your total home and then the square footage of just what you use for business. And the simplified option just takes that square footage for business times $5 up to a maximum of 300 square feet. There's another method called the regular method where you actually take the actual expenses of your entire home, right? That's mortgage, utilities, and then it takes that business percentage of the total square foot divided by the business square foot to get that deduction. But I will say home office is a big red flag for the IRS, especially this regular method. So I only do the simplified option for my clients because it's the least audited, it's the least red flag. And this regular method can kind of get you in trouble too. If you ever were to sell your house and you've been taking deductions on your actual expenses like mortgage, utilities, then there's kind of consequences here when you sell it because that portion of your home will be considered business when you sell it. So that's why I never ever use that option. I always use that option.
I have a really big space because I teach art classes, so I have a room this size that I use, and I've been taking it off. I don't make a lot, but I've been taking it off because it's dedicated to only that and my artwork. So where do I look this up and learn more?
Yeah, just search home office deduction. Like I said, you can do the regular method to get the higher deduction, but it might hurt you when you go to sell your home because you've been taking deductions on that portion of your home. So when you go to sell it, that portion of your house will be considered business. You might have to pay cap gains on that when you sell it. So that's why I never do that. I always do this. And then yes, it's only up to 300 square feet, but it's not gonna hurt you if you ever sell your house. So if you're never gonna sell your house, then don't worry about it.
I don't have any plans to today, but.
Okay. But just know too that there's two different methods, so if you have a tax preparer, you just wanna be sure, maybe ask them which one they're using and tell them which one you wanna use, right? So just be aware of that. Again, sales tax. If you're selling tangible property, you'll have to charge your net sales tax. You don't have to charge sales tax on services or labor. And then, yes, we already said this, Colorado Department of Revenue website has free sales tax classes, and then also most of the home rule cities in Colorado do, so like Colorado Springs, Denver, whatever. So the thing that's complicated about Colorado is we have these things called home rule cities, which is basically all the big cities. They can have their own sales tax laws separate from the state, okay? So the state can say one thing they have to collect, but if you do business, if you ship or even ship to something in a city in Colorado that's a home rule city, they could have totally different rules. So one city may say, yes, that's taxable in our city. One city may say, no, that's not taxable in ours, but you still have to file in every single city, home rule city that you're doing business in, and with the state. So it's very complicated in Colorado. Some of my businesses, especially those who go around, because in Colorado you charge sales tax based on the location of where you're going or where you're selling, okay? So you could end up having multiple sales tax licenses with the cities, and you're gonna have to remit multiple tax returns to different cities and to the state, so it gets very complicated. And if you're selling online and you sell outside of Colorado, then you don't have to worry about sales tax at all, okay?
Oh, that's not true. You've gotta actually contact that state, and you have to go ahead and set it up with that state.
Online?
I ran into that problem too. Yes.
Alright. Well, I know some states are really getting on the big retailers, that's why Amazon and things like that, they have to pay sales tax. But generally, other states only require you to charge it if you have like a presence in that state. So it just all depends. It really depends on the state and what you're selling. So just know there's a lot involved with sales tax. So if you do, just make sure you know what you have to do, okay? In Colorado or any other state if you're online. All right.
Could you say that again, because I didn't hear you. In Colorado, you pay Colorado tax, and if you're selling things online and someone from another state?
Generally, you don't have to, but it all depends now on what other state and then what you're selling to, so.
The reason I'm asking is I have things shown in California,
Right.
but if they wanna buy it,
You're shipping it to them in California, right?
I'm shipping to California I haven't done it yet, cause I don't know how to do that, so I wanted to ask, there's an online gallery system, and they promote everything, but then you ship it, and, I don't know if the money.
Well, sometimes a lot of those sites, they're also handling the sales tax for you too, so are they doing that part?
I haven't looked into that part.
Okay, we'll look into that, because a lot of times those online sites will do that portion for you, like they'll do the sales tax and all that for
Like
you.
Amazon?
Yeah, even when you're doing like events, like if you're doing a special event, when you get that special event license or that particular event, they'll do all the sales tax for you. So it just depends. You have to look into who's doing that. Like, cause I know like Etsy stores, they'll figure out the sales tax for you. Stuff like that. I mean, you'll still have to get licenses.
If it's shown over there, I should sell it through Etsy or Amazon to, have that be handled?
You could, yes. So if they're doing it for you.
What's that?
Yeah, if they're doing it for you. Which
You'd probably save money if you called, since you're going to California, I would just call the California State Sales Tax Office
Yeah, you have to
and
find out
ask them how to handle that, being that you're from Colorado and you would be shipping it to California, selling it, the destination is California.
if they say you don't have to worry about our state tax or anything like
I
that, then
don't
you're
think
fine.
they would.
No, some states you don't have to.
Yeah,
Nevada
some
you
states,
do.
they don't care.
Yeah, Nevada you do. But if you just call them and find out, cause if you go through Amazon or something, they're gonna take a lot of your profit.
Well, that's what I
Yeah.
was thinking.
They'll take a lot of your profit, so I would just call the
I just
Colorado.
have small shops in California that are interested in having my stuff up, and I got confused.
So if they're physically selling your stuff in their shop in California,
Yeah,
then they should be collecting the sales tax when that customer comes in. You shouldn't have to be charging.
so
'Cause
basically I'm
If they're
wholesale.
buying from you wholesale to resell, then yeah, you don't have to worry about sales tax.
Yeah.
So if they're purchasing from you to
No,
resell,
they were just gonna show it, it's in the works, and I wanted to know what I'm doing before I jump in with both feet.
So, yeah, it depends on whether the product that they have there is actually going to be sold.
Or for
Right.
an example.
Or if
Right.
it's an example, and you'll be sending something else.
yes,
You know, if
you're
you
technically
actually are
selling it.
making it here and sending it, then it'll be subject to different rules than if they sold it there.
Yes.
Than if they sold the one that they had.
Oh, it gets complicated.